Well, today has all been about one big number and one big sheet of paper. Big number came from the eurozone, and it showed that eurozone has fallen into outright deflation, minus 0.2% in December. That's worse than expected, and as you can see here, it is largely to do with the falling oil price. Of course, oil is part of the index. It will naturally bring inflation down. However, you can see that that move towards deflation was well underway even before oil started its fall last summer. So there is not just the transitory effect of oil there. The big sheaf of paper was the minutes to the last FOMC meeting, which was a very important one, you might remember, in December. It was the one where the Fed announced that it was going to be patient about raising rates, and this was initially interpreted as a sign that they were going to be very dovish. You saw the S&P rally more than 5% on the back of that. It was recently right back to where it was before that meeting. Meanwhile, bond yields, having risen quite a bit after that announcement, are now lower than they were before then. There were perhaps two key takeaways from those minutes that weren't clear before. One is that the Fed doesn't appear to be worried about the strong dollar, which obviously could be part of pushing down on inflation, but that implies that rates could still be rising despite the strong dollar. The other is that they continue to describe the oil price impact as transitory on inflation, also a hawkish signal. That makes very interesting this chart we're showing you here, which is one of the Fed's favourite measures of inflation expectations, the so-called five-year forward. It's the market's implicit expectation of what inflation will be starting in 5 years for the 5 years after that. This should be completely unaffected by the latest moves in the oil price, but you can see that today it dropped below 2% for the first time since 2010. So you have two very pronounced effects. You have falling oil, which is a transitory effect, but there is plainly on top of that a genuine fear in the market of deflation. That makes the Fed's professed interest in raising rates this year, which is plainly there and plainly something we should prepare for, given these minutes, perhaps a little strange. Now, for the rest of this week, we will be hearing from the Bank of England on Thursday. Any significant development there would come as a surprise. And then on Friday, we have the ever-interesting non-farm payrolls here in the US.